Welcome to Real Estate and Taxes with Lakshay, where we help you minimize your taxes.
Good afternoon, everyone. Thank you guys for joining in. Welcome to my Tuesday session on real estate and taxes. For today, we're going to be focusing on 5 tax secrets to reduce your taxes on real estate investments in Canada. So it's going to be a quick one again, 20 minutes tops. So let's go for the ride. Today's agenda is technically on what are the 5 strategies that we can use to basically reduce our taxes. Number 1, I'll be talking about how you can use RRSPs to reduce your tax liability. Then we're going to talk about Principal Residence Exemption and a little bit of changes to those. Number 3, we'll be talking about how you can set up a corporation to pay lower taxes. Then we're going to go into refinancing your existing property, which is a cash out refinance. And we're going to end this presentation off with a TFSA and self-directed investments and how you can use the money in your TFSA towards private mortgage lending and private mortgages. So let's get started. First and foremost, we all know what an RRSP is. RRSP is basically a registered retirement savings plan for Canadians to save for their retirement. So if you are an individual who is, wants to put away some money for your retirement, this is the best account to use. And when you contribute to your RRSP, you basically get a tax deduction on your taxes. So now, how can we use RRSP to the maximum advantage? The best way to do that is, let's assume you had a capital gains or you had sold an investment property in the current year where you had a capital gain of $100,000. If there's a $100,000 capital gain, you want to reduce your taxes because that $100,000, 50% of it is taxable, and it gets added to your personal income. So if your income for that year is approximately $100,000, you will be paying taxes on $150,000 because $50,000 of the capital gain got added to your personal income. So now, how do we manage that? How do we reduce the tax liability, which has basically increased from what we were sitting at as $100,000, now it's at $150,000. So how do we reduce that? The best way to do it is look at your notice of assessment and it will give you your contribution room. Based on your contribution room, maximize it. Per year, you have a contribution room of approximately $29,000 per year. You can do a maximum of $29,000 contribution to your RRSP to reduce your tax liability for that year. So once again, if you have a property that you have disposed of in the current year and you wanted to reduce your tax liability, use the capital gains that you get from that and throw it inside your RRSP account, because when you contribute to your RRSP, it basically reduces your tax liability. Once again, a lot of people think that if I contribute $1 to your RRSP, it increases the tax liability by $1. That is technically incorrect. If you contribute, let's assume in my scenario, if you contribute $50,000 to your RRSP and you're in the highest marginal tax bracket, which is 53%, you will only reduce your tax liability by $26,750. It won't eventually wipe out all of the tax liability, but it can certainly help you. So in this scenario, we contributed $50,000 to your RRSP, but the dollar impact on our taxes was only $26,750. So hope this helps in, shedding some light as to how we can couple together the RRSP and capital gains to get a better impact and reduce our tax liability. Number 2 is Principal Residence Exemption. A lot of the people who have been in the business of actually, flipping and, occupying a fixture upper, living there for 6 months and then, claiming it as their principal residence and then, not paying taxes. So I have a friend who's, for the last 10 years, all they have done is basically move into a property, fixture upper that property, and then claim it as their principal residence because they lived in that property and then sell it for a profit. So what they were trying to basically do is whenever you ordinarily inhabit your home or you live in that home with your kids, your family, or you have only one property, you don't have to pay taxes on whenever you sell your principal residence. So we all know that in Canada, a lot of the people from the business side who are, in the construction business were using this rule to their advantage, basically buying a fixture upper, moving in that property, and then basically selling it at a profit. When they sell it at a profit, they basically claim it as their principal residence and now they are paying no taxes. CRA didn't like that. And now what they have done is they've put a rule that you must live in that property at least 12 months. Otherwise, we would deny your principal residence exemption. Yes, you heard it right. Even on your principal residence, they're going to start charging taxes if you don't live in that property for at least 10-12 months before selling it for a profit. There are some exceptions in terms of how you can avoid it, but there are some exceptions on CRA's website, like if there's a death in the family, if there's a divorce in the family, or there's like a separation or illness or injury where you had to forcefully dispose of the property before 12 months. Only in those circumstances you can basically get away without paying any taxes on your principal residence. But this new rule of living in it for 12 months at least before we're selling it, that is something that has shocked the real estate industry and people who have been in the fixture upper business. So keep in mind that this has changed, and even if it's your principal residence, you're not always exempt from taxes. If you want to exempt, or if you don't want to pay any taxes on principal residence, you need to live there for at least 12 months before you flip it, or if you move to a different property for a profit. So that sums up my second strategy of principal residence exemption. Now let's look at number 3. Number 3 is cash out refinance. Everyone knows what a refinance is. So let's assume you have $1 million home and you owe $600,000 in debt. With that means your equity portion on that is basically $400,000, just like in your example. On that $400,000, you can basically refinance it and get 80% loan to value. So in this scenario, what you can do is you can basically pull out, if you have $400,000 in equity, you can go 60% or 80% based on your bank to pull out more cash from the home and basically increase your mortgage. So now you must be wondering, why would we want to increase our existing mortgage? We might be paying $2,000 a month. With pulling out more equity from our existing home, our mortgage will increase. The idea behind pulling out equity is to basically manage your portfolio or grow your portfolio. So right now you have one property, but what if you wanted to not dispose of that property and multiply and invest in another pre-construction or another property that you wanted to use the money for? You can simply go to the bank on your existing mortgage, do a cash out refinance where you'll be able to pull out cash from your existing mortgage and use that money towards a different investment. Now, in this scenario, the best part is when you pull out more money on your existing mortgage, or you do a cash out refinance, you don't have to pay taxes. Why? Because it is only the debt that is increasing. It is not your income. It is just simply you're borrowing more money to expand your portfolio. I'm sure you're going to be using that money to multiply your rental properties and increase more income. So a cash out refinance is a great strategy for someone who wants to not pay taxes immediately and want to pull out money from their existing mortgage and use it towards increasing their income. So look into this strategy because it can certainly help you grow your portfolio of investments without having an additional tax liability. All right, so a lot of you guys are wondering, should I be buying investments or real estate investments personally or under corporation? There are a lot of variants that we can think of. Right now, I'm only going to be thinking of from one angle, but there's various other angles that we can, maybe you can book an appointment with me and we can sit down and talk and work through those. But for today's purposes, I'm going to first look at if you were to buy a property personally and you have a rental income of $35,000, and then you can deduct all of these, expenses in regards to interest, utilities, property taxes, management and administration, capital improvements, and your total expenses worked out to $15,000. Total expenses are $15,000. You're left with a net income of $20,000. On that $20,000, if you had a $100,000 personal income, your total income became $120,000. So you're buying it personally. The rental income also get reported on your personal taxes. If you are based on the 100,000, I just picked a number, you're in a 33% tax bracket. So that means your tax liability would be $39,600, from the overall perspective. Now, if you were to buy the same property and use it under corporation, how does the taxes change? With the same level of income, rental income, and the same level of expenses, we have added benefit because under a corporation, you have the ability to pay salaries, dividends, and various other things that are not eligible under the personal self. So in this scenario, what I did was, assuming you have a lower income spouse or you have a kid in home who help you with, cleaning the houses or collecting rents, doing management and administrative duties, and you pay them a minimal salary of $20,000. Now your $35,000 of income has $35,000 worth of expenses, so that means your net income hasn't changed, become zero. On zero under corporate taxes also becoming zero. So now you're able to wipe out all of the income against the expenses. Your corporate taxes become zero. You only have to pay taxes on your personal income, which is $100,000, and with 33% tax bracket, you're sitting at $33,000 of taxes. This resulted in a tax savings of $6,600 simply by maneuvering and using your salaries for lower income spouses or paying your kids from your corporation. So these kind of maneuvers and these kind of situations, personally, it doesn't really allow you on your personal taxes, which is why it is always beneficial to look into the direction of buying under a corporation. There are various other factors where the mortgages are a little bit difficult, the rates might be higher, you might have to give personal guarantee. But the long-term perspective says if you're going to be in the business of buying and selling the properties where you're going to be flipping, keeping a few on rental, and doing all sorts of things like that, and most of you guys are realtor, you should always look into a direction where you're not buying it personally, you're buying it under the corporation. It might not make sense to buy it under corporation if you're just going to be having a couple of properties. It only starts to make more sense when you have more than 3, 4, even 5 properties. So all in all I wanted to highlight in this slide is basically how you can save taxes, how you can look in the direction of using the corporations to basically minimize your taxes in the long run. The tax-free savings account. This will basically wrap up today's presentation, which is the last strategy. We all know what a tax-free savings account is. It basically is a account that is given by, it's a tax sheltered account where once you put in the money based on your current limit, you can basically, any growth that happens on those, whether it be your mutual funds or your stock portfolio individually that you might be buying, as they grow from $10 to $20 to $100, any capital gain or any gain that you make on those investments, they grow tax-free. The contribution that you make, unlike an RRSP, they're not tax deductible, but it is still a great strategy for someone who's saving for their retirement. So now let's look at it, how we can use it for our real estate purposes. Most of the TFSAs are actually self-directed. You put it into a mutual fund which is pre-existing, and they invest in various stocks in the market. What I am suggesting over here is you can technically do self-directed investments under your TFSA using a couple of companies like Olympia Trust and Computer Share, because they allow you to direct how you want to use your TFSA or how you want to grow your money in your TFSA. Instead of using stocks, which is also a great option, you can actually put money in the real estate industry. You can earn money by lending money on private, and right now the private rates are crazy. It's like 13% interest rate plus 5% lending fee, which works out to like 15%. This is the kind of growth that can really be done tax-free if you were to do a self-directed investment under your TFSA. You can also invest in real estate investment trusts that can sometimes give you a better growth than would the market give. All of you or most of you guys are real estate brokerage owners or real estate agents. So this is something that is very, very lucrative for you because you guys understand the market. You already know the market has dropped 20 to 25%, and a lot of people are in the need of money because they have closings coming up. They had lined up these various properties where they're going to sell one property and pull out the equity and down payment and close the other property, which is not happening because they weren't able to get the right price for the existing property. So now they have to close the second one, and the existing one, they're not able to get the price they want. So private mortgages or private lending is a great way to earn additional income. And the best part is, if you do it under TFSA, you don't have to pay any taxes, because under TFSA, any growth that you have, any lending fee that you earn, any interest that you earn on the money that you have lent is actually growing tax-free. So that kind of wraps up all the 5 strategies that I wanted to discuss with you today. Thank you once again for joining in.